Hello, Dr. Phil here. This is going to be a video on stock valuation. So let's get right into it. So let's start by talking about common stock. Okay. So a share of common stock is more difficult to value in practice than a bond for at least three reasons. So the first one is with common stock, not even the promised cash flows are known in advance. With a bond, it's more contractual. You're supposed to get you get your coupon payments every period, typically semi-annually. Number two, life of the investment is essentially forever because you don't have maturity on common stock. If you buy equities in a company, you just own it until such time as you sell it, or hopefully it doesn't happen, but the company goes bankrupt, goes under. And number three, there's no way to easily observe the rate of return that the market requires, which of course is available for the bond market. So let's talk about cash flows. So imagine that you are considering buying a share of stock today. So you plan to sell the stock in 1 year. You somehow know that the stock will be worth 70 bucks at that time, which not really very realistic, but we'll go with it. You predict the stock will also pay a $10 per share dividend at the end of the year. If you require a 25% return on your investments, what is the most you would pay for the stock? In other words, what is the PV present value of the $10 dividend along with the $70 ending value at 25%? For the present value, so we just plug in our numbers. It's going to be 10 over. So think about the 10 plus the 70. The 10 is the dividend. The 70 is the ending value. So we just basically 80, right? Simplify that over 1.25 because we're looking for a 25% return and we get 64. Okay. And then continuing, let P sub 0 down here, look at the equation, be the current price of the stock and then assign P1 to be the price in one period. So think of P0 as the price like today, present value, and then think of P1 as the future value in the sense of that's going to be the price in a year's time. If D sub 1 is the cash dividend paid at the end of the period, and then R is the required return in the market on this investment, then we could formulate this as P sub 0 equals D sub 1 plus P sub 1 over 1 plus the rate of return. All right, let's talk about growth stocks. So you could be wondering about shares of stock in companies such as Alphabet. That's the company that, if you're not familiar with Alphabet, that's the company that owns Google, but currently pay no dividends. So small growing companies frequently plow back everything and pay no dividends because if you're growing and you're trying to scale the business, increase the operation, if you will, scale the operation, you're not paying money out of dividends to shareholders because you need to keep the money to grow. You need it to grow the business. Okay. So the question is, are such shares worth nothing? And the answer really is it depends. So when we say that the value of the stock is equal to the present value of the future dividends, we certainly are not ruling out the possibility that some number of those dividends could be zero. They're just not going to all be zero. Okay. So imagine a company that has a provision in its corporate charter that prohibits the paying of dividends now or ever. Okay. The corporation never borrows any money, never pays out any money to stockholders in any formal fashion whatsoever, and never bothers selling any of its assets. Such a corporation really wouldn't exist because the IRS wouldn't like it, because there'd be nothing to tax, and the stockholders could always vote to amend the charter if they wanted to. But for some reason, this is again very, very unrealistic, but this is just the example we're looking at here. If for some reason it did exist, well, what would the stock be worth? The answer is nothing. It would be worth absolutely zero, right? As it says, a company would be a financial black hole, right? Money goes in, nothing valuable ever comes out, right? Who is gonna, if somebody said to you, yeah, put $10,000, 50,000, 100,000 into this company, and you will get literally nothing. Nobody's going for that, right? That's a terrible idea, right? So, like they say, the example is a little absurd, but it does illustrate that when we speak of companies that don't pay dividends, what we really mean is they're not currently paying dividends. The odds are at some point in the, from inception to sunset, they will at some point pay dividends. All right, let's talk about this idea of zero growth so you can understand this a little better. So a share of common stock in a company with a constant dividend is much like a share of preferred stock. Okay? Dividend on a share of preferred stock has zero growth and is constant throughout time. For a zero growth share of common stock, what we're implying is that D sub 1 is D equals D sub 2 equals D sub 3. So basically D is constant, right? That's like a fancy mathematical way of saying that the dividend is the same every year. Okay. Oops, sorry, I think we got ahead of ourselves there. So the value of the stock is simply Present value, P sub zero, is the dividend. Think about year one, year two, year three, and then so on into perpetuity. Okay. So in that case, the per share value is just given by P sub zero. Present value is just D over R. Okay. So basically just the dividend amount over the rate, where R is, of course, the required rate of return. Now, ideally, I mean, we could certainly get a company that pays, if we go back real quick, like zero growth, it just follows the, it's the same amount every year. Ideally, we'd love to have a company that pays increasing dividends. So suppose we know that the dividend for some company always grows at a steady rate. We call this the growth rate G. So if we let D sub zero be the dividend just paid, then the next dividend, D1 or D sub 1, is simply D1 equals D sub 0. So think like D1 is like, say, like a year from now, equals D sub 0, which is now the present value, times 1 plus G. And then, 1 plus the growth rate. So the dividend in 2 periods is, then it would just be D sub 2, again equals D sub 1 times 1 plus the growth rate. Okay, so we're just basically factoring in a growth factor each year. Okay, so we could just keep repeating that process to come up with a dividend at any point in time in the future. And this could really go on into perpetuity. So the dividend T periods into the future, dt is given by, as you see, D sub T equals D sub 0 times 1 plus G. And then what we're going to do to account for differing periods is we're just going to use the exponential T. And then, so if that was 5 periods, it would be to the power of T or 5. If it was, 14 periods, then it would be to the power of 14. So the dividend growth model determines the current price of a stock as its dividend next period divided by the discount rate less the dividend growth rate, and can be written as follows so long as the growth rate G is less than the discount rate R. Okay. Oh, otherwise, you kind of, it's kind of counteracting itself in that sense. So we got our formula here, which we could just simplify down to D sub 1 divided by R minus G. So where R is the rate and G, of course, is the growth rate. Okay, and remember, we can use this model to get the stock price at any point in time, right? The stock price just being really just P sub 0. We can interchange that for P sub T. And again, simplify it out. So D sub T plus 1 divided by R minus G. So let's look at a numerical example. So let's say that D sub 0 is $2.30, R is 13%, and G is 5%. So the price per share in this case is, we just plug in our numbers, right? So P equals D0, D sub 0, 230 times 1 plus G. So that will just be 1.05, right? 1 plus 0.05 growth rate G. And then over 0.13, that's R, and then minus 0.05, which is the growth rate. Okay, so the growth rate is obviously, the difference is 8%. So 2.415 over 0.08, and we get $30.19. So that's what we calculated. Does that mean it's really going to happen? No, but that's what we're calculating the per share price should be. Suppose we're interested in the price of the stock in 5 years' time, so now P sub 5 instead of P sub 0. We first need the dividend at time 5, or D5. Because the dividend just paid is 230 and the growth rate is 5% per year, then D5 would just simply be 2.30 times this would be the factor, 1.055, which of course is 230 times 1.2763, and we get 2.935. Okay, and then if we go ahead and plug the numbers in, what do we get? We get 38.53. Okay, so basically saying at the end of sort of period 5, then it should be now worth 38.53. Now, let me say this: does this always work? No. This does not factor in, other market conditions, prevailing market forces and factors, real world events, natural disasters that could affect the company and mean that they can't pay dividends. All right, let's now talk about what we call non-constant growth. So the main reason to consider this case is to allow for what we call supernormal growth rates over some finite length of time. So required dividends start growing at a constant rate sometime in the future. So consider the case of a company that is currently not paying dividends. You predict that in 5 years, company will pay a dividend for the first time. The dividend will be 0.50, so basically 50 cents per share. You expect that this dividend will then grow at a rate of 10% per year indefinitely. Now, again, is that really realistic? No, because no one can guarantee you that. The required return on companies such as this one is 20%. What is the price of the stock today? So firstly, find out what it'll be worth once dividends are paid. So the price in 4 years will be, again, we've got P sub 4. The price in 4 years equals D sub 4, the dividend in 4 years times, again, 1 plus G, 1 plus the growth rate. Again, same formula over R minus G. So if we plug in our numbers, what do we get? We get $5. So as a corollary to that, if the stock will be worth $5 in 4 years' time, then we can get the current value by discounting this price back 4 years at 20%. Okay, so we're taking that 5 and we're just kind of like dragging it, discounting it back 4 years, and we get a value of 241. So what we're really saying there is the value right now is 241, but if this assumption holds, then in 4 years' time it'll be worth 5. Suppose you have come up with the following dividend forecast for the next 3 years. After the third year, the dividend will grow at a constant rate of 5% per year. The required rate of return is 10%. So what is the value of the stock today? So you can see the 3 years here. Expected dividend year 1 is $1, then it goes up to $2 in year 2, and then $2.50 in year 3. So with dealing with non-constant growth, I would say it's actually easier to do a timeline, and you can kind of conceptualize this a little better, right? So you can see the 1, a year from now we've got 2 at the end of the second year, and then we have $2.50 at the end of the third year. So the value of the stock is basically the present value of all the future dividends. So we're taking all those dividend amounts we're going to get in the future, and we're just dragging those values back to today's dollars, in essence, right? That's the present value, right? The value as of today. So the first thing we'll do is compute the PV of the stock price 3 years down the road. So we're going to plug in our 250 multiplied by 1.05 because the growth factor was 5%. And then the rate was 10%, the growth factor was again 5, so we're just looking for the difference between 0.1 and 0.05, and then we get P sub 3 of 52.50. So that's the value of the stock price, not now, right, but down the road. Again, if it said P sub 0, like you see in number 3, that's the present value, right? P sub 3 is the future value 3 years from now. So then we're going to add in the present value of dividends that will be paid between now and then. That's what we're doing down here. You can see this 0.10, because remember that's the rate. 2 over 1.10 to the power of 2 because it's 2 years out, and then 250 over 1.10 again to the power of 3 because it's 3 years out. And then what do we get? We simplify it out and we get $43.88. All right, so earlier we calculated P sub 0 as P sub 0 equals D sub 1 over R minus G. Remember, R is the rate, G is the growth rate. If we rearrange this to solve for R, we get the R minus G equals D1 divided by P sub 0. Okay, so the total return R has two components. Okay, the first one is the dividend yield. This is the stock's expected cash dividend divided by its current price. Now remember, it's expected. That's what they think it's going to do. Doesn't mean that it will. Number 2, dividend growth rate G can be interpreted as the capital gains yield, the rate at which the value of an investment grows. So suppose we observe a stock selling for $20 a share. The next dividend will be $1 per share. You think that the dividend will grow by 10% per year, more or less indefinitely. Again, is that really realistic? Probably not, but let's just go with it. So the question is, what return does this stock offer if this is correct? So R equals the dividend yield plus the capital gains yield. So again, we just plug in our numbers. So the dividend will be $1 per share, so $1 over 20 plus 0.10, that's the growth. The dividend will grow by 10% per year. And then we simplify it out and we get 15%. All right, so what about stock valuation using multiples? So these are things like PE ratios, for example. So a very blatant problem with the previous approach, the dividend-based approach to stock valuation, is that many companies don't pay dividends, so everything we just did is mute, right? Like it doesn't work. If the company's profitable, i.e. it has positive earnings, we would probably use the PE, what's called the PE ratio, price earnings ratio. This is calculated as the ratio of a stock's price per share, its current price per share, which bear in mind changes all the time, to its earnings per share over the previous year. So the idea is to have some sort of benchmark ratio, PE ratio, which we will then multiply by earnings in order to calculate an expected price. So the price at time t equals P sub t, which equals the benchmark PE ratio multiplied by the earnings per share. So the benchmark PE ratio could come from a variety of sources. It could be these are usually nationally and internationally quoted. Could be based on similar companies. Could be based on a company's own historical values. The PE ratio is also based on estimated future earnings, which is called a forward PE ratio. So this is where we're getting into more of a sort of a forecast because we don't really know. Some companies do not pay dividends, nor are they profitable, which stay away, right? In this case, we're going to use the price to sales ratio, calculated as the price per share on the stock divided by sales per share, or the EV over EBITDA ratio. So basically, think of like earnings valuation. EBITDA, that's an accounting term. Earnings before interest, taxes, depreciation, and amortization. Now, one other thing I'll say about this, where it says some companies do not pay dividends, nor are they profitable. So you might be like, well, what? Why even talk about that? Why would I invest in them? Well, maybe they're a new company, maybe they're a startup, and you're like, okay, they're losing money right now to be expected because they've just opened the doors, but I think they will make money down the road. So it may actually be a good investment. All right, so let's talk about some features of going back to the very first thing we talked about in the lecture today, common stock. So common stock is equity without priority for dividends or in bankruptcy. So if you're a common stockholder, you're generally like in the line of all the people to collect money. If the company goes bust, you're pretty much at the back. Okay, so shareholders elect directors who in turn hire managers to carry out their directives. Directors are elected each year at an annual meeting by a vote of the holders of a majority of shares who are present and entitled to vote. Okay, so in cumulative voting, a shareholder may cast all votes for one member of the board of directors, and then all directors just are elected at the same time. In straight voting, a shareholder may cast all votes for each member of the board, but directors are elected one at a time. So that's just really the difference. Many companies have staggered elections for directors. That's what we call classified boards, but several have been pressured to declassify. So why might they stagger? Well, one, it makes it more difficult for a minority to elect a director. That could be good and bad. And then number two, it makes takeover attempts less likely to be successful. So that's good for the company standpoint if they don't want to be subject to what's called a hostile takeover. All right, so let's talk about proxy voting and stock classes. Okay, so a proxy is a grant of authority by a shareholder allowing another individual to vote his or her share. So it's done by proxy. Somebody else is basically doing it for you that you have authorized. Shareholders can come to the annual meeting and vote in person if they choose, or they can transfer their right to vote to another party. Most voting in large public corporations is, of course, done by proxy. If shareholders are not satisfied with management, an outside group of shareholders can try to obtain votes via proxy, with a resulting battle called a proxy fight, usually when they're trying to oust management and management trying to stay in. Some firms have more than one class of common stock. So if we look at like FMC, Ford Motor Company, they have Class B common stock, which is actually not publicly traded. That's just a private offering. The primary reason for creating dual or multiple classes of stock has to do with control of the firm. If multiple classes exist, management can raise equity capital by issuing non-voting or limited voting stock while still managing to maintain control. Some other rights we should talk about just real quick with respect to common stock. In addition to the right to vote for directors, shareholders usually have the following rights: the right to share proportionately in dividends paid, the right to share proportionally in assets remaining if the liabilities have been paid in a liquidation. A liquidation, just think about that they went bankrupt. The right to vote on stockholder matters of great importance, for example, mergers, acquisitions, etc. Stockholders sometimes have what's called a preemptive right, which is the right to share proportionately in any new stock sold. So if they sell new stock, then rather than potentially diluting your ownership to have even less, they have to offer you the same amount of stock to where if you had 5% of the company before and they issue more, you would still have 5% thereafter. Okay. All right, dividends. I'm sure you've all heard of dividends. Think about money the company is paying out to their current stockholders. So a distinctive feature of corporations is that they have shares of stock on which they are authorized by law to pay dividends to their shareholders. Dividends are payments by a corporation to shareholders, typically made in either cash or stock. It's usually cash. It could be stock, especially if it's a newer company. Payment of dividends is, of course, at the discretion of the board of directors. So if if they don't have a good year, they may not pay them. Some important characteristics of dividends include the following. Okay, so until it's declared by the board of directors, it isn't a legal liability of the corporation. Payment of dividends by the corporation is not considered a business expense, and thus dividends are not deductible for corporate tax purposes. And then dividends received by individual shareholders are taxable. So in 2020, the tax rate was 15 to 20. So it was 15 if you fell within a certain income bracket. If you made more money, like more like regular income, like W-2 income or 1099 as well, you may end up in the 20% bracket. All right. So what is preferred stock? You may have not heard that term. Preferred stock has dividend priority over common stock. Normally with a fixed dividend rate, you typically without voting rights. So if you want to vote for in a company, you need to get common stock. If you want a little bit more safety, you're probably better off getting preferred stock. So preferred shares have a stated liquidating value, usually $100 a share, with a cash dividend described in terms of dollars per share. So a $5 preferred translate into a dividend yield of 5% of the stated value. Now the preferred dividend is not like interest on a bond. Okay. Firstly, board of directors may decide not to pay dividends on preferred shares, which and that may have nothing to do with how profitable or not the company is. In that case, common shareholders must also forego dividends. So they can't say to the preferred shareholders, "We're not paying you," and still pay the common stockholders. They have to not pay both. The holders of preferred shares are often granted voting and other rights if preferred dividends have not been paid for some time. So it's kind of like a way to appease them, get them back on side. Hey, like we know we haven't paid you any money dividends for a while, but we're going to let you vote instead. Dividends payable on preferred stock are either cumulative or non-cumulative. Um, Basically meaning if it's cumulative, they have to pay you any amount they owe you in arrears. If it's non-cumulative, they don't have to do that. As it says, most are cumulative. Unpaid preferred dividends are not considered to be debts of the firm. Okay, they're not legal liabilities in that sense. Okay, the last thing I want to make sure we touch on is this dealers, because I always get a lot of questions about this, dealers and brokers. So we know that the stock market consists of a primary and secondary market, right? The primary market is for any market, not just stocks, really anything at all. The primary market is the first time it's sold. The secondary market is every time thereafter that it's sold. Most securities transactions involve dealers and brokers. So a dealer is an agent who buys and sells securities from inventory. They stand ready to buy securities from investors wishing to sell them, and then, of course, sell securities to investors wishing to buy them. So the dealer is kind of like a middleman. Think like a car dealer, for example. The price the dealer is willing to pay is called the bid price, and the price that they'll sell is called the ask price. So the difference between what they're paying and what they're then selling it for, I believe be more, right, is called the spread. Okay, and that's how they make their money. A broker, on the other hand, is an agent who arranges security transactions among investors. They do not buy or sell securities for their own accounts, but rather facilitate trades by others. So I think when you look at these two, there is really a difference between a dealer and a broker. Okay, thanks.